So one of the first steps taken towards alleviating yourself from these emotional effects and having a better grasp of trading psychology is first assessing your account. What that is asking yourself, what does your trading account mean to you? If you're trading with $5,000, how important is that to you? What's the worst case scenario that could happen to your trading account? Let's say 30% loss. Let's say 100% loss. These are all potential scenarios that all depend on what and how you are trading. More importantly, though, how does the worst case scenario make you feel? If you are trading with $5,000 and you have a chance of losing all of that money, how is that making you feel? How important is that money to you? Is that a month's paycheck, or is that just a weekend out to you? It really depends, right? Everyone's different and everyone has different financial situations, which is really suggested not to overextend yourself, especially in the beginning as a trader, because you're going to make mistakes, and it's better to learn from those mistakes with a smaller account than it is to lose $10,000, $20,000, $30,000, $50,000 because you decided to go big on your first year of trading and you got stuck in a meme coin that is not going to ever go back to where you bought in at. Now, if the worst case scenario makes you feel uncomfortable, makes you feel stressed or anxious with anxiety, then you're taking on too much risk. At this point, you should consider trading with a smaller account. Figure out what amount of money you can trade with that will not trigger negative emotions, or thoughts, and then trade that account just as you would use a practice account, right? So let's say if you're trading with $10,000, but you can't sleep at night because you keep thinking about these positions that you're in overnight, you're trading with too much. Maybe you should cut that down to half, maybe even less. Maybe cut it down to $2,000, or maybe even $1,000, or even less, maybe $100, right? It doesn't matter, especially in the beginning, the amount that you're trading with, because we're trying to learn. We're trying to build the habits and build the skills and build consistency, right? It's trading on the long term is all about consistency, consistently building wins and consistently adding that percentage gains, and consistently minimizing your losses and minimizing your risks over time, because that's really what is going to compound your trading account and compound your wins over time. Another thing to keep in mind is technical analysis and how that factors into trading psychology. So TA and trading psychology can often complement each other in a variety of ways that better inform the trader's decisions. Traders must rely not only on the chart that they're analyzing for information, but also rely on their own prior knowledge of the coin's price history, the macro trend, which is the bigger trend, and this is found once again on the larger time frames, focusing on the daily, the weekly, the monthly. Also looking towards fundamental changes with the project and much more bigger picture ideas to confirm or deny a trade idea. Now, with this, traders with discipline, knowledge of all factors that could affect the coin's price, and confidence without too much emotional overlap can find success in their decisions, right? We want to be confident in our choices, but at the same time, we don't want to be overly confident and have a level of greed that blinds us to what could go wrong. So one of the best practices in regards to overcoming emotion and improving trading psychology is solidifying their trading plan or their strategy. A trading plan is a strategy that has proven to be profitable over time. Now, this strategy is followed every single time a trade is placed. It's based on a set of rules or conditions that make it easy to follow. This is something you want to do every single time, not just once in a while when it comes up, but every single time you enter a trade. You want to follow the same plan. It's the only way to know how successful it is. Now, a great way to force yourself to stick to the plan is to clearly write it out step by step. Write out exactly what you're looking for. Write out what conditions you want to see, whether that's price coming back to support, maybe certain indicators, conditions, or more. Clearly write out why you entered the trade. What was the basis of your analysis? Now, this can be done in your trading journal. And every time you enter or exit a trade, you should note whether or not you followed your strategy. It can also be beneficial, and this one I like a lot. It's beneficial to write down your emotional or mental state every time you enter or exit a trade, along with the typical entry and exit numbers, to better track if your emotional state is affecting your trades. If you're following this and every single time you enter a trade, you're feeling excited, you're feeling pumped up and really eager to see how the market goes, that's a sign that you're letting your emotions get to the best of you, and that you're making these financial decisions, such as entering a trade. You're letting yourself base those decisions on your emotions, which is a danger sign, right? That's a dangerous thing to fall into. So staying true to yourself, writing out all of these details. It doesn't have to be anything fancy, just kind of keeping a mental note for yourself by writing it down. That way you can go back and review. All right, well, I was feeling emotionally charged. I felt like FOMO because it looked like Bitcoin was pumping. There was some really good news. I felt like it was a good time. And if you find yourself doing that more and more, that's a sign that, well, maybe you need to take some time and reflect on your practices. Now, just as the archer that we discussed earlier, the trader's skill remains the same in all situations, whether they are trading in a simulated program or trading for income. Now, in a paper trade situation or a simulation, winning or losing doesn't really matter, right? It's not real money. It's not affecting us on a day-to-day basis. As we paper trade, we don't have to consider the consequences of our actions, and this could be a potential drawback or a downside to paper trading. It doesn't mean anything if you have a bad trade or if you decide to change your strategy or rules, because maybe if you're using real money, you wouldn't have entered that trade, or maybe you wouldn't have doubled down on your bad trade, right? Price came down to an even lower point below your first entry. Well, maybe you want to double down and put even more capital into it, and you're thinking, well, it's not real money. That's something that you wouldn't normally do, most likely, if you're trading with your own real money. Now, the biggest thing here is that there's no money to be gained or lost, and as a result, there is nothing to be anxious about. You can't have negative emotions in the moment that could potentially sabotage your results if you're not necessarily using real money, right? Think about it as similar to Monopoly money. It's useful for many purposes in getting the hang of the idea, but I highly suggest that you start with real money, even if it's just $10 or $20, right? It does not have to be a large amount. It's always better to get the feel for it and to test yourself to see if you can handle that, right? Because we always want to start small and then slowly build to larger sizes. Now, there are some consequences when we are trading with real money. There's consequences to our actions. This can include the gain or loss of monthly income. If you're living check to check and you're dumping $3,000 into crypto to trade with every month, that could be a problem, especially if you have to pay your mortgage or you have a family to provide for. Another thing to consider is the loss of all trading capital. If you get stuck in a position or if you get liquidated, right? These are things that we always have to consider what could happen. A loss of self-confidence regards to how you feel about yourself when you're trading. If you are not confident when you're entering the trade or when you're planning for the trade, it may not be as successful or compared to if you were confident in the trade, right? We should always be confident in the moves that we're trying to make and confident in our analysis. Otherwise, we don't take the trade. Another consequence could be the compounding of interest to build wealth. If we're losing or if we're winning, that's something that could happen, right? And the idea of this could lead to certain people being blinded with greed, right? They're getting so caught up in the idea of compounding and constantly getting that 3% every day, that 2% every day. If they can constantly do it, they can make so much money, and that can start to lead to the point where you're chasing profits and not necessarily focusing on the process. Same thing with the gain of financial independence here, right? We're focusing more on the result and not as much on the process. The reality is both winning and losing can be life-altering. Now, in regards to managing our mental states, I find proper risk management to be crucial to avoid having too much emotionally charged decisions in planning and actually executing your trades. With that, you want to create a risk management plan that you strictly follow. Have protective stops on all your positions, even if you're watching them live, right? We have this habit of canceling them here and there, moving them if we're watching it live. Protective stops should be something that you set and then return to on a future date. Now, this will lower stress and worry as the worst case scenario is already outlined. Another thing to consider is that a major part of being successful in trading is not only knowing how or when you're right, but also knowing when you're wrong. What does this mean? This is having an idea of where your trade idea is invalidated, right? We shouldn't look at a trade idea or a chart and think, oh, it's only going to go in this direction, right? We want to consider the other direction as well, right? What is most likely to happen, right? If we're really confident about the price going up, all right, we can consider that the most likely thing to happen. But what happens if the most likely thing to happen doesn't happen? What if the most unlikely thing happens, right? Such as price going down. Where is your trade idea invalidated? At what price is your trade idea wrong? Where will you cut your losses to save your account? And part of that, these three questions right here are so key to creating proper stop losses, right? Like creating your stop loss at a point of invalidation, where if price comes down to this point, we know that the trade idea is wrong. We're probably going to go even lower. So these are things we want to consider in regards to risk management. Sticking to strict conditions for trade entries and strict stop losses will help you become more focused and remove the emotional part of trading out of the equation. And there's a famous quote by Stephen Hart, a famous trader, investor. Trading psychology is not what you do while you're in trade. It's what you did before you ever pressed the buy button, which is very true. It's so much more about the planning of trading and planning your trades, doing your analysis, understanding where you're invalidated, right? It's not so much about the actual things that you do in the trade, because if things are going right and if things were set up right, it's really all based on what you did before you even entered.